Hi. Hey, so now what I want to talk about relative to stocks and investing is risk and return, risk versus return. We always hear about that, right? And that's really the key relationship. And so, this is really what we're being paid for is to we're basically buying risk, And so, why do stocks go up over time? Is it luck? Is it timing? Is it speculation? That those are the kind of questions, everybody asks, right? But the real reason is because returns exist because risk exists. No one pays you extra to take no risk. Why would they, right? You're taking risk, and now we have to learn how to analyze risk. That's going to be one of the things, and how to price risk. So if an investment has guaranteed returns, it pays the least, like interest in the bank or bonds, things like that, right? Risk-free bonds. Now, the starting point for thinking about risk and return is U.S. Treasury bonds. Now, U.S. Treasury bonds have been traditionally thought of as the risk-free asset. They're backed by the U.S. government. They have the lowest default risk of any asset, and it sets the floor for all of the returns. Now, recently, because we have a dysfunctional government, Congress and all, we've come close to defaulting from not paying, the interest on and principal on our bonds. And so there is more uncertainty now. And so there's kind of a risk premium baked into even the risk-free asset of U.S. Treasury bonds, but it's still the gold standard. So that's what we price as the baseline for like a risk-free investment. It's the benchmark. It's basically a guaranteed return because there's no meaningful default risk. And that's the theory. We're talking that, and that's how. I mean, but that's also how investors price it. So why invest in stocks? Well, stocks are more risky than treasury bonds, that's for sure. And the reason we do it is we want to earn more return. We want to earn more return than the risk-free rate. Prices fluctuate up and down. That's volatility. That's basically how we measure risk is the volatility. A stock with greater volatility is considered more risky than a stock with less volatility. How much the price goes up and down on the short-term basis, kind of thing. And outcomes aren't guaranteed on stocks. Companies fail, and markets can fail. So the uncertainty is real, and that's what we have to anticipate, and that's what we're pricing, and that's the risk that we are willing to bear. And so our risk appetite, how much appetite we have for risk, the more appetite we have for risk, the higher returns we can get, right? So the risk premium, the premium over the risk-free rate of treasury bills, and you can look and see what a 5-year treasury bill is or a 1-year treasury bill is between, as traditionally being between 5 and 6% a year. So if a treasury bill is paying 4% a year, a treasury bond, so that's just an average what it might be paying now. 6% premium would mean that stocks are going to deliver, that investors would anticipate and want, a 10% return. And now we're starting to talk about some pretty nice returns, right? So, yeah, the risk-free rate plus that, and this is the historical long-term estimate, and it's our compensation for uncertainty, but it's not guaranteed, right? So the total expected stock return is the risk-free rate plus the ERP, equity risk premium. Like I just said, 4% plus 6% would be 10%. So that's basically, what we're looking at, right? Now, what risk is and isn't, it's not losing money, it's not volatility alone, but that's the proxy we use for, you know, doing our calculations. Risk is the uncertainty of future outcomes. You can say, well, I think Google's going to they made this much in profit this year. I think they're going to make this much next year and this much the year after, but that's uncertain. We don't know that for sure, right? Those are our predictions, and that's what everybody's doing. Um, so the real, definition is the risk is the probability weighted range of possible outcomes, right? If something's 20% possible of outcome and another one is, 50% possible, those predictions, and some get better or worse than are going to be expected, but that's how we have to think about it. And volatility is not our enemy. The going, a stock that really swings wildly, be like, oh, I'm going to stay away from that stock. That stock's going to give you a better expected return because investors, including you, are going to expect a better return for buying that volatility base, buying that risk. So what happens is the short-term noise obscures the long-term signal. So that's what we want to, that's why we're not thinking short-term here. We're thinking long-term. That's what matters to us as investors, right? They see over here how, yeah, it's going up and down, but it's over time going up. The long-term trend is up and to the right, as they like to say. Hmm. Um, so that is the core trade-off, right? Higher expected return is going to be higher risk. There's no free lunch in the financial markets except uh, the fellow, I can't think of his name right now, but the guy who invented, and we're going to talk about that, diversification, said that's the only free lunch in the world, to have a diversified portfolio. That means having more than one stock in your portfolio. So as one goes up, the other, might go down. One goes down, the other comes up. And they uh, equal out some of the systemic risk. And so that may be considered a free lunch, but we'll get to that later. There's really no free lunch. Think of it now. If there's more, if you're going to bear more risk, you want to get more return, it's going to be a riskier investment. So yeah, there's no high return without taking on uncertainty. And not all risk is the same, right? Um, there's market risk, and market risk basically, can't be avoided. That's systemic risk. What I was saying with diversified, it affects all stocks simultaneously. Recessions, interest rate changes, geopolitical events, diversification can't eliminate that. But diversification can eliminate the unsystematic risk, the risk from specific companies like management failure, product recalls, all these different kind of things, competition. And diversification can reduce that. By holding more than one company, you can reduce some of your risk, the unsystematic risk, the company risk. And that's really important. So we're going to talk about portfolio construction and diversification and things. So here's, the big idea, and it's going to come soon, as we go through this. Some risks can be reduced without reducing the return. That is the key. That's diversification. This is the most powerful free lunch in all of investing. It's called diversification. So how do we measure risk? Now we're getting ahead of ourselves a little bit here, but I just want to give you an idea of where we're going and how we do this, using some math, right? It's how risky is a stock relative to the market? If the market goes up, how much does a particular stock go up? More than the market? If this or less than the market? And if a stock goes down, same thing. Does it go down more than the market went down, or less than the market go down? That's what beta is. A beta of one, if a stock moves with the market. A beta of greater than one, the stock is more volatile than the market, and a beta of less than one, the stock is less volatile than the market. So we're looking at this relationship, and that's what beta measures. And so, and you can see beta on any stock chart, underneath the stock, you will see the beta measurement, and you can look at that. Now you'll know what that means, right? So the real insight here is you are being paid to take on an uncertainty. The discomfort of watching the prices fall, that is the product. I mean, that's basically it. Investors who stay through volatility are compensated. Those who flee are not. The last thing you want to do is when stocks start to go down, panic and sell. You want to stay in the market and trust that you made good decisions, right? That's really the key. That's what we're trying to do. So why do investors struggle? Well, they get scared during downturns and they sell at the worst possible time, locking in their losses and missing the recovery. If you've been watching the stock market lately, it went down and then it came back up. And you have to just sit that out, and if you're trying to, chase returns, something starts running up. It's like, I got to get in on that. And then you suffer the inevitable correction. You don't want to be chasing when everybody's piling into a stock. That's the time to stay away from it and maybe even sell as it goes up and then buy it after that inevitable correction when it comes back down. You can do some of that, but it's hard to guess the market. You just want to stay in there and pick great companies and just ride with them, and misunderstanding risk, and making irrational decisions when you think the normal volatility is some kind of catastrophe. So emotional investing is the biggest destroyer of long-term returns. We want to do this as unemotional as we can. We want to stay, cool-headed. You have to be ice cold to do this, right? And that makes it interesting too. So this is how professionals think. Risk is priced. Every unit of risk you take should be compensated with an expected return, right? Risk is measured. You use beta, standard deviation, portfolio theory to quantify exposure. We're going to go through all that kind of stuff. And risk is managed, right? Diversification, asset allocation to different, sectors, all kinds of this, where you're going to put your money. Um, and the time horizons reduce unnecessary risk by being long term. You reduce a lot of risk because things take time to get good. So then what we're going to talk about next in these kind of topics are diversification, how to reduce risk, beta, how to measure it, and CAPM, the capital asset pricing model, which incorporates beta. So that's how to price risk and determine expected returns. With these tools, you can turn risk from a feeling, just like, oh, I think it's risky, I don't think it's risky, into a framework, a real analytic framework. And that's what we're trying to do, right? So So here's the big thing, return is what you earn, right? The reward for patience and conviction in your, what you thought the company was going to do, and risk is what you endure, in the meantime, all the ups and downs, it's like a roller coaster ride, you know, and it's the price of admission. It's basically what you're being compensated for. And the relationship between these two is what investing is built on. So that's why it's important to go over this early on and understand it. And understanding this is what separates investors from gamblers, from speculators. So there you have it. And hope that was helpful. And I'll catch you in the next one.